Hello friends, welcome to Wealthy Options. This is Reddy. In this video, I am going to explain what is a call option and how it can be used it for investment and trading purpose. In my previous video, I have explained what are futures and options in detail. You can find the link for that video in the description of this video just in case if you have missed to watch it. Now let's look at the definition of call option contract. I will then explain it with by taking one of the share as an example. Right. A call option is a financial contract that gives the option buyer the right but not the obligation to buy a stock, bond, commodity or other asset or instrument at a specified price within a specified time period. The stock, bond or commodity for which you buy the option is called the underlying asset. Finally, a call option buyer profits when the underlying asset increases in price. Let's say, according to your analysis, you think Reliance share price will go from here and you want to get an advantage and profit out of this potential up move by either investing or trading in a Reliance share price. Now, Reliance is currently trading around 1920 rupees per share. Now, I'll take a multiple scenarios to explain how a call option can be used it for both investment and also for the trading purpose. So now let's say you want to buy 250 shares of Reliance and current price is 1920, and if you want to buy these shares in current market you need an investment of 4,80,000. Now let's say you don't have this entire capital of 4,80,000 but you can able to arrange this amount by end of this month. However, you don't want to wait till end of the month because the Reliance is currently trading around 1920, which may be a fair price according to you, and if you wait till end of the month, so the share price may go up to 2000 or 2050, which may not be a fair price. Now, so what is the instrument, what is the option available for an investor to buy the or to get the right to buy the Reliance stock right at 1920 rupees, though you do not have a complete capital? In this case, you can buy Reliance current month call option contract, which is May 2021 at a strike price 1920. The capital required to buy one lot of 1920 call option is 14,375. So now I will take you to the options chain for Reliance to explain even how we arrived at this 14,375. So what you see here is the Reliance option chain from NSE website. So as you could see, I have selected Reliance as an underlying and expiration date as May contract. Now all the options that you can see on the left side are call options and right side are put options. Now let's focus on the call options because you want to buy 1920 strike call option and the premium for 1920 strike call option is 57 rupees 50 paise. So in order to buy one lot of Reliance 1920 call option, you need to multiply this 57.5 into 250 because one lot is equal to 250 shares. So which comes out to 14,375, which is the capital required as I mentioned earlier. Now by paying this 14,375 as a premium, now you got a right to buy Reliance shares at 1920 rupees before end of the May, irrespective of whether the share price, Reliance share price goes to 2000, 2100 or any price for that matter. Now let's look at the different scenarios, how this call option contract helps you. Let's say your analysis is correct and Reliance share price goes up from 1920 to 2100, which is 180 rupees gain per share. Now as you originally planned, so you arrange the required capital of 4,80,000 to buy Reliance shares at 1920. Now because you bought the Reliance 1920 call option, now you have a right to buy Reliance share at 1920, though the share price appreciated from 1920 to 2100. So now who is going to give a delivery of your 250 shares at 1920 price, though Reliance is currently trading at 2100. So this is where the responsibility of delivering these shares will be with option seller. So obviously when you bought the contract, someone would have sold you. So it is the responsibility of a seller to buy the stocks at 2100 from the market and still give it to you at 1920, right? And you don't need to really worry about, I mean, who is the exact seller, because exchanges take care of settling when you are exercising these contracts. So in this case, you are able to buy Reliance shares at 1920, though they are trading at 2100 rupees, because you paid a premium of 14,375 rupees by buying a Reliance call option. If you have not paid this premium and if you wanted to buy Reliance shares at current price of 2100 per share, now your investment would have been 5,25,000. Now, as a buyer of a call option contract, you have a right but not the obligation to buy the shares. Now, let's say when you have decided to not to buy the shares but to take the profit as the Reliance share appreciated from 1920 to 2100. So, in such case, you can do the same by selling your contract to someone else. Okay, so in this scenario, so you bought the 1920 call option, and now the Reliance share is trading at 2100 at the end of the May month. So which means this call option value would be 180 rupees. You remember you paid the premium of 57 rupees 50 pice. You paid the premium of 57 rupees 50 pice because the Reliance share went up by 180 rupees and the Reliance share is trading at 2100, right? And the call option contract what you bought is 1920. So Reliance is now currently trading at 2100 and the contract you bought, the strike price what you bought is 1920. So the difference is 180 rupees. So your 1920 call option contract would be trading around 180 rupees. You can sell this contract to someone else around 180 rupees and you can make a profit of the difference between the premium paid and the 180 rupees, which would be approximately a profit of 120 rupees. And if we convert into the money terms, so 180 minus 57.5, which is 122 rupees 50 paise is your profit. So multiplied by 250, you will get the profit of 30,625. So in this way, you can actually use your call option for trading purpose instead of investment purpose. Now let's say Reliance share price dropped to 1700 rupees instead of appreciating. Now just because you bought the 1920 call option, it doesn't mean that you need to necessarily exercise your contract and buy the shares at 1920. So this is where the concept of you don't have the obligation comes into the play. Now obviously when the Reliance is trading at 1700 rupees in a cash market, it doesn't make any sense to exercise your contract and buy the shares at 1920, because if you buy in the cash market, you can buy it for a much cheaper price and your investment cost would be less. So in such case, what you can do is you can leave your call option contract to expire worthless. So in which case you will lose the initial premium whatever you paid, which is the 14,375, or before end of the contract, if it is still trading with 5 rupees or 3 rupees or any value it is trading, you will get that money back out of this 14,375. On the other side, when you buy the Reliance shares at 1700 rupees per share, so for 250 shares your investment would be 4,25,000 rather than paying 4,80,000 if you would have bought at 1920. So this way you can actually buy the Reliance shares at a lesser price than your intended price. Now let me do a quick recap of all the three scenarios. In first scenarios, you wanted to buy Reliance shares at 1920 and you did not had enough capital, so you bought the 1920 call option. Reliance share price went up from 1920 to 2100, but because you purchased the call option, you had a right to buy and you bought the Reliance shares still at 2100 rupees. In second scenario, you bought the call option, Reliance share price went up from 1920 to 2100. However, you decided to not to invest in Reliance shares but to take the profits out of the table. So in that case, so instead of exercising your contract, you sold your contract to someone else and you book the profit of almost 120 plus rupees per share, and then use that as a trading opportunity. In third case, your analysis went wrong, and Reliance share price, instead of appreciating, it has gone down from 1920 to 1700. So as the Reliance share is available in the cash market for a cheaper price, you decided to not to exercise your contract, but you let the options contract to expire worthless, and you have purchased the shares in the cash market at a much cheaper price. So these are the different ways you can able to use the call option contract. Now let me quickly come back to the definition and relate to this example. So as per the definition, to buy the stock or bond. So in this case, what you are buying is a Reliance shares call options, and at a what price? So specified price is 1920. So this strike, whatever you purchase, this is called the specified price. Specified time period, right? So you are buying a May month contract, so you can able to exercise and do anything with this contract before end of May month, but not beyond the May month. So this is where the specified time period comes into the picture. And finally, the underlying asset. So in this case, what is the underlying asset? Reliance is your underlying asset. So what it means, if Reliance share price goes up, your call price will go up, and if the Reliance share price goes down, your call price in fact will depreciate, and it can potentially go to zero as well. Another important point is, when you buy a call option, you don't need to necessarily hold till the end of the month if you decide to use it for a trading purpose. Let's say in this scenario, you bought the call option at 57 rupees 50 pice, and let's say on the same day, Reliance share price goes, it goes up by 30 rupees, and your options premium shoots up from 57.5 rupees to 77.5, which means your option contract is trading with a profit of 20 rupees. So when I say option contract, one lot is equal to 250 shares. So that means 250 into 20 rupees, your option contract is actually in profit of 5,000 rupees. And if you want to book the profits and take the profits from the table, you can do that just by selling your contract in the market. Or say you bought the Reliance call option and the Reliance share price is going down, and so the call option premium also. So in which case you can square off your position by selling your contract to someone else and then come out with the minimal loss. So now, as you could see, you can use these call options for a multiple purpose, either for an investment or for trading purpose. So in trading purpose, you are actually using these call options as a leverage instrument, because you are able to get onto a bigger position by paying a minimal capital. And apart from these things, these call options can be used for hedging purpose and also for building a multiple strategies. I'll cover all these things in detail in my upcoming videos. Now let me show how the payoff diagram looks like when you buy a call option. So I took the same Reliance example. So we have bought 1920 call option in May series, and obviously we bought call option and it's a one lot. And the premium we paid was around 57 rupees 40 pice. And what you see here is the payoff diagram for the Reliance 1920 call option contract. So on the y-axis you could see the profit and loss, and on the x-axis you can see the Reliance price. So we bought the Reliance 1920 call option when the price is around 1920. Now as you could see, as the Reliance share price goes up, the options premium also goes up. In fact, it is a unlimited profit potential, right? So you could see, if Reliance share price goes to 2145, so you may get an approximate profit of 40,000. If it goes to 2400, you may get an approximate profit of 1 lakh. And what about the risk? What about the potential loss? So the potential loss could be whatever the premium you paid, which is approximately 14,350, right? So what it means is, if Reliance share price goes up, you have a chance to make a unlimited profit, and if Reliance share price do not go up above the 1920, you will lose your entire capital. That is entire, when I say entire capital, all the premium, option premium you paid, which is 14,350. And if you look at the break even, so you bought the 1920 call option contract by paying a premium of 5750. So the break even is, it's a 5750 plus your strike price, which is 1920. So that becomes a 1978. So now as you could see, the break even for this is 1978. So what I mean by break even is a call option buyer, if they want to use it for a trading purpose and want to hold the contract till the end of the month, so he will not be able to make the money unless Reliance share price goes up above the 1978 price at the end of the contract. Of course, in between, if the call option price goes up above the 57.5 price, and if they want to book out the profits, of course one has always has an option to book out the profit and come out of the contract. This payoff diagram is useful to understand what is the potential maximum profit, potential maximum loss, and break even point. I believe now you got good understanding of what is call option and how it can be used it for investment and trading purpose. Please like and share this video with your friends if you found this useful. Also, please subscribe to my channel and click the bell icon so that you will not miss my future videos. Please check the description of this video for more details, especially to get the access to all my live trades during the live markets. Thank you for watching and goodbye.